founders started asking me for investment. This is how I want to put my money to use, not to buy real estate, not to just buy stocks, but to actually fund the new innovation.
Our guest on the program was Ihar Mahaniok, founder and managing partner at Geek Ventures, venture fund investing in immigrant founders. Ihar, what did we discuss today?
Oh, it was a great discussion. So we discussed a lot of fundraising of the venture fund, how we fundraise for Geek Ventures, how to approach fundraising, how to start a venture fund, how to become an LP in a venture fund, what to be looking for in the founders, what does it mean to be an excellent founder, how did I find these 5 seed companies that became unicorns, what I learned from my engineering career, a few things from my personal preferences and my dream.
This was a masterclass on fundraising as a venture fund. We discussed how Ihar got into angel investing 11 years ago, how he caught 5 unicorns. He told about the idea behind Geek Ventures, the average check size, investing frequency. We went into the nitty-gritty tactics and details on how he started, how he builds the deal flow, how he picks the companies to invest, his investing frameworks, how he wins the right to invest, how he helps his companies, how he exits his companies. A lot of details which will be super helpful for both founders and investors. I hope you enjoyed it as much as I did. Welcome everyone, nFactorial podcast coming to you from New York City. Today our guest is Ihar Mahaniok, founder and managing partner at Geek Ventures. Ihar, welcome to the program.
Thank you, Arman. Thank you for having me here. I really enjoy your podcast and glad to be talking to you.
Thank you for finding time. So congratulations first of all on 2 things. You raised a $23 million round for Fund 1 at Geek Ventures. And number 2, as an angel investor, you already caught 5 unicorns on a seed stage. My first question to you is, tell us more about Geek Ventures and how did you get into angel investing?
So Geek Ventures is a venture firm in New York City that invests in immigrant founders in the US at early stage. So I created Geek Ventures 2 years ago, and we announced that we successfully raised a $23 million fund a couple of weeks ago. And we have been investing actively over the last year and a half, got more than 30 investments already. And we have been investing very early from idea stage to about million ARR in amazing startups with founders from all over the world, founders that come to the US, with about half or so of our startup founders from Eastern Europe, which is the region that we love. So we've been enjoying it so far. Team of 7 people already. And you asked about angel investing, right? So
Correct.
Before starting Geek Ventures, I've been angel investing for more than 10 years. And how did I get into it? Well, I was working at Google at the time and was also heavily involved in startup ecosystem without being a founder, more like from connecting people to opportunities. And I saw many startup founders doing great things, and I also started hearing success stories, right? So about startups going, raising great rounds, going to IPO. Like it was, I think, the year when Facebook went an IPO and so on. So, and founders started asking me for investment. So that was the time, and okay, that makes sense. This is what I want to put my money to use. This is how I want to put my money to use, not to buy real estate, not to just buy stocks, but to actually fund the new innovation.
When did you sign your first check?
When I think it was sometime in 2012, and the very first investment was in a Swiss company. I was living in Switzerland at the time, and there was a Swiss company that tried to create a marketplace for home cleaning.
Like HomeJoy.
Yeah, so which, it was very, very early days of gig economy, and they were doing something in that area. And yeah, that was a very interesting, very exciting company. Unfortunately, it was working on a very small market in originally Switzerland, and they proved that growing like country by country is fairly tough. But that was really good start for me.
When did you invest in Instacart? That's like a legendary investment. So congratulations on the recent IPO.
Thank you. Yeah. So that definitely became a a big thing recently because they went public, and it is and it's literally like what, second company after ARM, after a year and a half of no IPOs at all, and first like properly company that goes from VC to IPO. And I invested right after their YC. It was like end of 2012, and they just had the launch in like several neighborhoods of San Francisco. I think they had like one store, like Trader Joe's, or maybe two stores that they were delivering from, and delivery was I was not even in San Francisco at the time, right? So I was in Zurich, and I couldn't even try it, but it made so perfect sense for me, because that was a time when Uber already worked very well. Everybody knew Uber, and gig economy was working. As you see, my first startup investment was gig economy, and Instacart was my probably number 2 or number 3. It was also gig economy. Like, okay, these guys should be able to do Uber for groceries without investing in their warehouse and without investing in all that stuff that actually like creates a lot of drag on their balance sheet. So yeah, and the way they already performed was great. So, and when I invested, Sequoia was not in the picture yet, right? So it was Hostla Ventures already invested, and only after that Sequoia led the next round.
Got it. So this was a seed round, sort of
Yes.
in the fall of 2012.
Yeah.
How did the opportunity arise? Did you find them? Did they reach out?
So the opportunity arose through Funders Club. So Funders Club was this very early website that allowed people to become angel investors. And right now it's much more convenient and easy to start angel investor than back then, but especially in a startup in Silicon Valley when you're not from there. And Founders Club was one of the first ones that created this syndicates and so on. So, and they had multiple deals. The Instacart was really the most interesting one. And the guys that run the Founders Club, they were actually also YC alumni.
Summer 12, yeah.
Yeah. So, and it was like they knew the other YC companies and they made it possible. So great, actually. Very thankful to Founders Club founders, Barry Silver and the others. So, yeah.
Wonderful. You have 4 more unicorns apart from Instacart, PandaDoc, People.ai, Airbyte, and Jeeves. Tell us when you invested, how did opportunity arise, and sort of what was your thinking behind the investment?
Yeah. PandaDoc was probably my investment number 4 or 5. It was early 2013, and that was a very interesting story because PandaDoc guys are from Belarus, where I'm from, and I found out about them from some online video pitch competition where they even had a previous product called Quote Roller, and they won a pitch competition. They got like this little award that wasn't like financially significant, but they're like, oh, I saw guys from my country winning an award somewhere else, and I found out that I have a lot of mutual friends with them. So I asked to be introduced. I got introduced, and I spoke with them, and I found out that the guys, the founders, were really, really good in what they're doing. Actually, interestingly enough, there was another competing company on Funders Club, and I don't remember the name anymore, that was in Silicon Valley with lower metrics and higher valuation than PandaDoc, and doing almost the same thing. And I was like, okay.
For context, what does the company do?
So the company right now is basically a sales proposal software plus document signature software. They started from sales proposals and sales proposal editing, collaboration, and so on, and they moved into a signature and paperwork space. And at that time, PandaDoc was already had revenue. They had clients that loved them. They had small team back in Belarus, but they had zero investment, and they were looking for some investors, and they offered very, very reasonable terms, lower than the company that's like rooted in Silicon Valley would offer. And I was like, okay, makes sense. And actually, I'm really, really thankful to Mikita, CEO of PandaDoc, that he convinced me that the minimum investment is much higher than my typical one. So he convinced me to invest more than I typically would. And that's great. That worked out great for me because the company is very successful in the end. And what I loved about this opportunity is that the guys were on the way to Silicon Valley, right? So they didn't have strong network there yet, but they knew they're moving there, and they knew that they will be raising the next round there. They raised this initial round for me and a couple of people in and funds in Europe. And then a couple of years later, in 2015, they raised a really significant round, Series A, from Altos and other Silicon Valley investors in Bay Area, and basically just kept going from there. And a couple of years ago, they became a unicorn.
Amazing. People.ai, what does the company do? How did you invest in them?
People.ai is a B2B software for sales analytics for big enterprises. And I met them through introduction through another startup founder, PetCube founder, Yaroslav Azhnyuk from Ukraine. And he introduced me to Oleg, who is People.ai CEO. And Oleg was like the most gifted salesperson I've ever seen. And he basically sold me on this investment in the first half an hour. And this was the perfect example of founder market fit, right? So Oleg was really good in sales. He had been a salesperson for a while. He had success in sales. And now he was building a company that would help VP of sales analyze salespeople. So it's all around his skill set. And he also was obviously really good in selling his product to the customers. He was good in selling it to potential employees. He was good in raising money, so selling it to investors. And I was like, yeah, I was probably not the first investor, but one of the very first few. And 30 minutes and I invested. And a couple months later, they actually got accepted to YC after my investment, and from there they took off. They got Andreessen Horowitz, invest in them, and so on.
Amazing. Airbyte. Again, what does the company do? How do you invest in it?
Airbyte is developer tools company, B2B, that helps you to work with data, helps developers work with data. This is a really crazy case because I think this is the fastest growing valuation that I've ever seen. So they grew more than 100x in valuation in 18 months. So, and that was a story that I basically just stumbled upon them through a syndicate, right? So, and before I started the fund, I always was, helping myself to understand what the market is just by looking at a lot of syndicate deals, right? So, if you want to invest in 5-10 deals a year, you want to look at 500,000 companies. And as an angel, it's really difficult to meet literally 1,000 founders because you just don't have time. But syndicate deals really help you to build the narrative and understand. And Airbyte, it just made perfect sense. So the founders were back then it was even called different. It was called Data Line. But the founders had a great track record, and they were attacking the right area that I was always, as an engineer, which I can tell more later. As an engineer, I was always in data, right? So since 15 years ago, data, ML, everything related to data processing. And Airbyte was solving some of the, not all, but some of the problems in that area. And they were super early in their product, but valuation was low, team was great, and so.
Wonderful. Jeeves.
Jeeves was the only fintech, not the only fintech that I invested, but the one fintech that really became successful. And the thing there is that, I'm not from financial sector myself, so a lot of this fintech were difficult to really figure out for them the market and so on back then. And for Jeeves, it was so obvious because Jeeves was also attacking my passion is working with international immigrant entrepreneurs. So Jeeves does credit cards and corporate business accounts for international non-US companies, non-US startups. And they were basically one of those first neobanks. And when they started, there already was Mercury and Brex, which made total sense in the US. And there was very little of those outside. And Jeeves, again, was a case of founders who knew their space and who took this amazingly huge market and did it right.
Yeah, one more company before we move on to the next segment. One company I really like in your portfolio is Chainalysis. Benchmark, I think, is one of the investors. Tell us more about the company and then...
So Chainalysis was one of those stories where I invested in a small topical fund by Funders Club, where it was, I think, very, very early days of crypto, somewhere I don't remember exactly, 2014 or so, when very few people believed in crypto, and very few people saw. And I was like, okay, I believe in crypto. I really like Bitcoin, and I want to see if I can invest in this space. And back then I was like, okay, I should invest in this little package of like five or 10 companies, and one of them was Chainalysis, right? So that was a case where I probably was more lucky, right? So that this company was there, and it became a huge success. I was following them and was trying to help them as well. So
wonderful. Let's look at your venture fund as a startup. It's in itself, right? As a startup, you have to raise funding. As a venture fund, you have to raise funding as well. Tell us about the fundraising process in your case, and then we can give some advice to aspiring venture fund managers.
Absolutely. So what I think is like really like not enough information about fundraising of venture funds, or even how to create a venture fund. I remember it was like middle 2021 when some people were asking me, "Are you gonna create a venture fund?" And I was like, I don't know how to do it, right? So because when you want to start a company, you see so many books about that, like, starting with Lean Startup, 0 to 1, hard think about hard things. And there's like just, hundreds and thousands of books. There are very few books on what does it mean to run a venture company or venture firm. And typically the venture firms that we know about are huge companies that were started long ago, like Sequoia was like 30 or 40 years old. Right. So, but at the same time, right now there are so many venture funds, right? So there are thousands of venture funds of all sizes, and 2021 was the time when I was like basically on crossroads in my own career, because up until that time I was mainly like having jobs in engineering space, right? So I last was a VP of engineering at a Series A company. Lightning AI, and I got some offers for another VP of engineering jobs, and I was like, okay, do I want to continue, VP engineering as a day job and like angel investing as my side gig? What do I really enjoy? And I have this like thinking that everybody hopefully should do things that is as their main job, that is on intersection of what you love to do, what you can do, and what others will pay you for, right? So, and I knew for sure that I love investing way more than I love the, engineering. And I also realized by that time that I basically got at least some of my imposter syndrome go away, because I started seeing companies turn into unicorns, right? So my seed investments. So, and it really showed me that I was able to select the right companies. And I saw that also that the companies that I invested in more recent years, like 2018, 19, right? So I was more selective. I saw more companies, and the companies I ended up selecting were growing much faster, right? So we mentioned only unicorns so far, but I have a lot of companies that raised rounds at more than 100 million valuation, and I invested at seed stage too, right? So, and also I started seeing that people want to pay for it, right? So in the sense that some people who were co-investing with me saying, hey, Ihar, can you take my money under management? And just like, then we don't need to discuss every investment. So, and I found this program called VC Lab. It's, we ended up, by the way, a little shortcut, we ended up investing in the company that runs VC Lab. But VC Lab is a free accelerator for those who want to start their venture firm. And I enrolled. I thought they wouldn't accept me. They accepted me, and I was there for a couple months, just full time, learning what it means to operate a venture firm. Figuring out what does it mean to have a thesis, what does it mean to to fundraise, what does it mean to how to set up the entities and so on. So all of that, and I started talking to people who would invest, and I can talk long and long about how actually the fundraising was. But basically, in short, I started fundraising probably in September, October 2021, and we closed it in June 2023 with about 70 LPs, $23 million fund. And it wasn't easy especially because the market turned right on me, right? So I started investing in a good environment, and very, very quickly the environment went bad, right? So we know that early 2022, the war in Ukraine started, the market went down, the Fed in the US started raising rates. All of that like really closed the liquidity, and raising for everybody started to be difficult, especially for funds.
Mm-hmm. And did you, how did you pick the fund size, and what's your suggestion for aspiring fund managers when it comes to the target fund size?
That's a great question. So basically, my method was that in late 2021, I tried to write down a list of people who I think people I knew who I think could invest, and the right number next to them, which I think they could invest, right? So, and then I probably had 20 or 30 people in that list, and of course, this is the sum that's very, very like kind of, aspirational, right? Because not everybody will invest. So, and I think I basically look at that, and that was 20 or 30 people. And I think I don't remember what I did exactly. I think I doubled that. So basically to set myself really high goal, and also understanding that a lot of people who will end up investing are probably not in this list. So, and then I started talking to people about investing, and in general, people could change the size of the fund during the fundraising. It's not a problem, right? So, and I've seen people starting to raise a 5 million fund and then raising 10 million fund, or opposite, starting to raise a 10 million fund and raising 5 million fund. So one rule though, you shouldn't change it too drastically, like not 10x. And in the beginning, my goal was 15 million. And I started talking to people I knew about investing 100K here, 200K there, $500,000. So, and I started getting commitments, right? So first from a very, very close circle, people who knew me very well, who trusted me, right? So, and this is my recommendation to other aspiring fund managers. You should always start raising from people who trust that you can do the job. They trust you personally, right? They don't necessarily take a look at your deck and compare it with somebody else's deck and go with stats analysis. They just trust that you can do the job because they know your work ethic, they know your focus, they know your abilities personally. And those people can be your first like several LPs. So for me, it was like first 3 or 5 LPs were exactly like that. And with that, I got some commitments. I got first, I think, $1.5 million commitments, which to me was like, okay, we crossed the 10% threshold. So I started to do the closing, and we ended up closing 6 million, first 6 million in December 2021, and started deploying this capital, while in parallel we kept raising throughout 2022.
Wonderful. What's your advice when it comes to people with money who are looking for alternative asset classes? How to become an LP? What's the path? Can anyone become an LP? How do I get access to great funds?
Great question. So in general in the world, there is this concept of accredited investor, and in US, you can invest in venture funds if you have at least 200K annual income, or you have at least $1 million in assets. And that threshold means that a lot of people, like from upper middle class, can do it, right? So, and for example, engineers at big tech often make more than 200K a year, so they could invest. And of course, businessmen or execs, and a lot of people who I spoke to were accredited investors and were allowed to invest in venture funds, but didn't know how to do it, right? So, and a lot of them didn't even, think a lot about alternative asset class or like how exactly they should deploy their capital, but they had their money either in, stock market, or in one stock, like Google employees would have it in Google, Microsoft employees would have it in Microsoft, or they would buy an expensive real estate, like for example, in Silicon Valley, you can end up buying a house for like $2 or $3 million because the prices are really, really high. And in reality, as long as you are a great investor, you can invest. You can invest in venture funds, and typically the minimum is 100K. Though there are venture funds that take less, 50K or 20K, and there are also, of course, venture funds that take more. And when you think about any brand name venture funds like Andreessen or Sequoia, their minimum is huge, like $10 million. But a lot of funds that are doing like small seed funds, and which are typically, not typically, maybe not the right word, but a lot of small funds are outperforming big funds and big well-known funds. You can come in with 100 or 200K. And what is important is that it's unfortunately, because of the laws on fundraising has to cannot be public, right? Unless you have a special dispensation, there is a special rule, just making like an asterisk. But very few venture funds use that rule to do public fundraising. Most venture funds don't do general solicitation and basically speak in private. But if you want to deploy some of your capital in venture funds, talk to somebody who who is either works at venture fund or runs a venture fund, and most likely they will have an opportunity for you, right? So like, for example, publicly on this podcast, I cannot really talk about whether there is an opportunity or not, right? So but in general, you can always ask somebody who runs a venture fund or even works at venture fund, and ask them. And what worked really well for me is that I would speak to people I knew from my previous jobs, from my circle, and ask them if they're interested in the venture fund. And then we would talk in detail about what it means, right? So, and what is important is that invest in a venture fund typically means trade-off between profits and liquidity, right? So investing in venture funds is on average much more profitable than investing in stock market. Stock market typically gives you 6% annual in long term, and venture funds on average provide about 20% in long term, right? So, but the downside with which you pay for this 20% is that the liquidity is very limited. So you can only take money out of venture funds whenever there is an exit. So yeah, and by the way, I had last year I ran a special session, education session for people who want to learn about venture funds, and I might run the similar session again, because this is specifically a case where a lot of people are interested, and there is so little content on how to become LP.
Wonderful. Here's a tactical question for you. Let's say I go through my list of acquaintances and friends. We have some commitments, but I quickly run out of that list. What's next? I haven't reached my target fund size. How do I get to it through introductions? So
there are several aspects here. First of all, it's a very valid approach to basically limit your fund size, right? And a lot of successful fund managers do a much smaller first fund, right? So I know a few friends who are doing really, really well, but their first fund was either a 2 million or 5 million fund. And basically, when you run this fund for a couple of years and you get some markups or exits, it will really help you to raise the next fund much larger. But other than that, what is important is to, first of all, one thing that I keep recommending, don't neglect your actual first circle connections, but like very, very weak connections, right? So because most people don't realize how many people they know, right? And by know, I mean like maybe you worked in the same company 10 years ago, right? So, but what's important is that it's so much easier to get a commitment for somebody who recognizes your name because they met you 10 years ago, just because they know that in this 10 years, they don't know anything most likely like, negative or like about you. They know that you are not a fraud, not a crook, they know you personally, even if it's a fairly weak connection, right? So, and most people have a lot of these weak connections, and then they underutilize it. I actually run a group of managing partner VCs, and we just discuss with each other fundraising and other things. And I see this, like, people say, somebody said that, oh, they only pitched like 30 or 40 people they knew. I'm like, I pitched 600, and out of 600, vast majority of people, I don't remember how they look, right? So like, it's kind of a name, and like it barely rings, but yeah, and they don't remember me very well either, right? But they remember me somewhat, right? So we have some connections. So, or even the next level is people who you might be even weaker connections, but you have like some kind of alumni association. Either you worked at the same company or you were at the same school, you know. So this really works as well. But you have to do an introduction, right? So in sense that you cannot do general solicitation, so you cannot just, you know, blast your fundraising to a bunch of random people who don't know who you are, right? So typically what works is create a list of people who you want to talk to, and find the introductory paths, like through LinkedIn, or LinkedIn is typically the best, and ask people in this path to introduce you, especially if the people in this path are your LPs already. What I found through my fund is that very few LPs proactively connected to another potential LP of their friend. Some do, but it's fairly rare, especially in the first fund. But they're all very happy to introduce you to somebody you ask them to, right? So it's like, you know, hey Bob, can you introduce me to Peter, because I see you're connected and I want to talk to him about my fund. Bob will introduce you to Peter, most likely, right? So why not? Especially if Bob is your LP, right? So basically, go through your LP's connections and ask them to introduce. Another thing that works fairly well is events. So basically going to a lot of events where you can meet a lot of people that could be your LPs, right? So for example, I like big tech conferences, like for example, Web Summit or TechCrunch Disrupt, or like, you know, this kind of conferences, and CES / and so on. Just go there and see if you can find either people who represent family offices, fund of funds, or just successful founders. And a lot of people who are like in the, you know, pre-seed and seed founders will not become your LPs, but people who have had some success already, or who are investors, might be interested to hear your story. So, but also most importantly, you'll get into this bubble, and then from big events, the next level is actually to go to small events, like really closed, intimate events. And I found it really works well to connect with LPs at small events where you get just because you know somebody, right? So in New York, there are all the time, there's like event for 20 people, 30 people, 40 people, right? Just for investors, or for investors and founders, or for like successful founders and so on. And you get invited to those when you expand your network. So one thing that is important to like hone again, if you want to run a VC, you have to have a network, and you have to build a network. And basically, in order to be able to raise your first fund, you have to already have a network. But in order to be successful VC, you have to keep improving your network all the time. And that's both for deal flow and for fundraising and for collaboration. And lucky for me, I love networking. I love meeting people. So my network keeps growing, and I keep meeting new people. So in 2 years I've been running Geek Ventures, I met probably a few thousand new people, and you know, it really helps. And because I keep meeting new people, I keep getting invited to some events, right? So, and sometimes it will take you a couple of years of like really dedicated networking to be able to raise a fund.
A question related to capital calls. Let's say you have a commitment for 500K. Do you get that in a single tranche, 2 tranches? What's your suggestion there?
So my suggestion is to actually get the first capital call as small as possible. I went with 25% because I know some venture funds that try to do the whole thing at once, and they end up, but they only end up having small funds, like $1 million or $2 million funds. Because when you tell LP that, you know, we need our minimum is 100K and you need to wire 100K right away, for people it's like, oh, it's often a big sticker shock, right? So it's like, oh, it's a big sum of money. But when you tell them my minimum is 100K, but you'll only need to wire 25, and the rest you'll wire over the next 3 years, they're like, okay, that makes much more sense. It's much more doable, right? So it's I know funds that start with 10% or 15% their first capital call, and then take the rest is like in 6 months increments or something.
Right, and then do you let's say you take 25% initially, and then the remaining 75%, is it like 25% year 1, year 2, year 3? What's
basically we are not set on a very specific schedule. We are set on like basically money as we need them, right? So, and there's another piece of advice is to only have a second capital call after you finish fundraising the whole fund. So because otherwise otherwise keeping fundraising after second capital call will become more difficult. Like for example, if you already did 25 and 25%, which is total 50, then after that everybody needs to put 50% right up front. But basically our approach has been from the beginning that we'll only call money as we need it. So, and we are actually doing another capital call this week because we have been deploying the capital very effectively in the last couple quarters. So we need more capital to keep deploying it in the next couple quarters.
When it comes to your investing frequency, I see that you do 1 to 2 deals a month.
Yes, correct.
How did you decide on that?
So I want to clarify that 1 to 2 new companies a month.
Yes.
We actually do more deals per month because we also do deals, follow-ons in existing companies. So how did we decide on that? So basically, from the beginning, that was very clear that in order to run an early stage fund, pre-seed and seed, you need a lot of companies in the fund in order to really have a high chance of success, right? Because the volatility on every deal is very high, right? So the chance of the company that's like pre-product or very early revenue to completely flop is high, right? So we are modeling that about half of our companies will go to zero. Even though, with our model, only one company out of 30 something in almost 2 years went to zero. But, that's where we start. And in order to smooth out this volatility and increase the chance of overall fund success, we decided to go 50 to 60 companies. And with 50 to 60 companies in the fund, and our main investing period is 3 years, our core investing period, to basically pick new companies. So that's basically how it goes, right? 36 months, we want to find 50 to 60 companies in 36 months.
So your average initial check is 150 to 200?
We actually go wider. We go from 50 to 200, between 50 and 200.
Got it.
And most of our checks is about 100 or 150. So basically, and our check has some connection to the valuation, to the ownership, even though our ownership targets are not very strict. And we set majority of our fund aside for follow-ons, because our approach is that, we want to have 50 or 60 companies in the fund overall, but we want to make sure that we double down on our winners, and we want to have second check in about half of our companies, and we want to about 5 to 7 companies in the fund to get more than $1 million from the fund, and maybe even more than 1.5.
Mm-hmm. There are 5 aspects of running a fund: building the deal flow, making the decisions, making the investment decisions, waiting the right to invest, helping companies to succeed, and then getting them to exit. Let's break it down. Let's start from building the deal flow. How do you actually build the deal flow? How do you find companies to invest?
Yes, so the deal flow is absolutely secret sauce of every VC, right? So every VC that pitches LPs and fundraisers has a different approach to deal flow. So my approach to deal flow has been multi-pronged. First of all, really strong network of warm introductions. I already spoke a little bit about network, and the fact that I invested in about 200 companies before the fund really gives me very strong connections to the founders of those companies, and those founders keep recommending me other companies. Like a couple days ago, I got another intro from a founder of PandaDoc to a promising startup, for example. I have really strong ties to alumni networks of Facebook and Google, also through warm introductions. So people who I either worked in directly, or the people who I worked with know somebody else who left a big company and they started a startup. And actually, we have at least a couple startups in our portfolio that are from those big companies. And then there is a huge connection to other investors, being angel investors, accelerators, and VCs, especially Eastern Europe, right? So I'm from Belarus, and I have several teammates from Ukraine, and we're all very connected to Eastern European fledgling, like fairly small but very dynamic investing ecosystem. And the investors from there find local gems, and they invest in them, and then they bubble them up to us, right? So for example, and I mean, we see great accelerators there, then we see like the best in their batches. We see angel investors from there, and we see what they see, right? So, and for example, our team members were in the largest Ukrainian tech conference last week, IT Arena, and there were a lot of great new companies coming in there, right? So basically, having some ties with like local ecosystems helps us see promising future immigrant startups early, before other US VCs can see them. We also have very good ties with other VCs in US and other companies, which share with us the moments where the company is like has their round partly filled and has some space for us, and we found that that's where winning the deal is important, right? So because it's not enough to just hear that the deal is there, and that's on warm, right? But we build a huge like fire hose of cold inbound as well, and that's where a lot of visibility is important, right? So, and I've been started building my visibility back when I was just starting angel investing, and when I was at Google, when I was representing Google, and then Facebook, and then when I was investing and I was giving advice on how to raise from angel investors.
You were a guest speaker in our bootcamp 9 years ago, 2014. Yeah.
You see, like that's an example, right? So, and I was speaking in Ukraine, in Latvia, right? So in Belarus and other countries, and Armenia, Azerbaijan, and so on. So it's like, and because all of those helped me with visibility. Most recently, of course, we are building a lot of visibility with Geek Ventures, and events is a big thing that we love doing events. Like every 3 months we do an event in New York. A couple of weeks ago there was another really successful event for founders and investors with more than 130 founders. We got good inbound flow from there. We are going to have an event at Web Summit on November 15th this year in Lisbon, and together with Flyer One and One Way Ventures and
Simeon Dukac, yes.
Yes, and that kind of event also helps us bring deal flow, but and press like LinkedIn, Twitter, and so on. So we are seeing about between 100 and 200 startups every month. Recently, after a couple announcements of the fund and so on, we're seeing more like 400 startups a month.
How many calls do you take per month?
So we have a team. So we end up as a team talking to probably about 40-50 startups a month, and we end up investing in, as you said, one or two. So the rest we end up, having to pass, unfortunately. Yeah.
Let's talk about the investing framework. How to make right investing decisions. I assume you have a phone screen when you have a investing committee. What's the typical process, and how do you make decisions? What are some of the helpful frameworks you use? What are some of your 2x2 matrices you use on a regular basis? Help us understand what happens in your brain when you make this decision.
Great question. So we have this framework is like what's critically important in the company, right? So, and especially early stage. One of the things is that everything related to founders, because we love investing in the team. We love investing in the best founders that are out there and the most promising founders. So, and especially we focus a lot on CEO, and we love when there is very clear clarity who is CEO, who is the leader, and so on. And we love to see somebody who has big vision, like something that can be really huge in 10 years. We love when there is a very clear founder market fit, so founder knows their market in and out, and we love seeing some track record. we do invest in first-time founders, of course, but as a first-time founder, they have to have some success in the past, at least at school, if they're like 20 years old. But in general, there should be track record, or maybe some other companies they worked at, or maybe companies they founded. We love seeing very clear conviction, right? So we never invest in founders that seem to be opportunistic, right? So kind of like, oh, this looks like an idea where I can like try a startup, sell it in 2 years to Google, right? So we only invest in those that this is where name Geek Ventures come into play. We love to invest in geeks that are passionate about something. They have been passionate about the space for a while, and now they started a company in this space, and now they want to run this company for the next 10, 20 years of their lives because they're super passionate. That's what we are looking for. And we besides, and of course, they should be able to sell this, right? So CEO should be the best salesperson because they need to sell this vision to investors, to employees, to customers, and so on. And then the market is critical, right? So we always look at the market, and whenever we see a startup that is in a small market, we pass very quickly, right? So, and our shorthand is that the market which they are going for should have a whole spend 10 billion a year, or at least forecasted to reach 10 billion a year in a few years, right? So because in that case, if they achieve 1% of that market, they will have 100 million a year revenue, which could get them to unicorn status. If they get 5%, they for sure will be unicorn, right? And we don't know, right? So if the company can get like 50% or 70% of the market, right? It's super difficult. We also like companies that disrupt and come to the market which is obviously growing very fast. So sometimes the market is small, but it's obviously growing very fast because it's super new, right? So it's like imagine like, everything related to mobile back like 15 years ago was small, but it was growing very fast. It was obvious, right? So coming into this growing fast market is great. And we also look at business models, right? So, and for example, B2B long subscriptions is very important way to have high retention and low churn, while like B2C subscriptions like $5 a month, kind of $10 a month iOS subscriptions could lead to very high churn and like difficult retention. So we do prefer like low churn, high retention businesses. What is important for us is that we've tried to find every shorthand, every single time we are investing in a company, we only invest because we believe this company can give us 100x return. 100x is our goal, which sounds a bit crazy for some, but for our early stage fund with 60 investments, we have to have high goals. If we cannot see that there is a potential of 100x return, we don't invest, right? So, and we don't invest in when there is like a company will be sold for $50 million if successful, right? Because what if, even if it's successful, we lost a chance to invest in a 100x deal.
How do you deal with FOMO? I mean, especially this year, there's a Copilot for X, Copilot for Y, generative AI for Z. Tell us how you think about AI startups. The valuations are high. There's so many of them. I think half of the YC recent batch was AI startups. There are quite a few companies which are good, but quite of them which are very low quality. How do you pick the right ones, the right horse to bet?
So, first of all, big advice to everybody who's investing: the larger deal flow you have, the less you will have to deal with FOMO, right? Because it's so much easier. Just today, we passed on a company on our investment committee that already had raised like almost the whole 2.5 million round and had like a little room left for us, and we could come in like last opportunity to get on this train, and we passed because when think about it, we have 10 more companies that we could discuss this or next week that look better from business model perspective, even though this one is like only the last opportunity to invest. And in the end, what I see is that 2023 is actually the year of no FOMO for investors. There is very little. Of course, there are a couple companies like Mistral and so on that go like super crazy valuations. But in reality, when you invest like 10 companies a year or 20 companies a year, this year there's very little FOMO because it's a investor-friendly market. It's a market where founders, where smart founders who don't try to hold valuations from 2021 raise faster and better. And you see this, and you understand that it's very, very unlikely that you will invest today at 5 million valuation and the next month they will raise at 10 million valuation. While in 2021 it was possible, now it's not, right? So
back to normal.
Back to normal. What it means is that, especially at early stage, another thing that because we invest mostly on safes, it's much more difficult to get really pure FOMO on safes, right? Because like, yeah, you told me you want to raise 700K round, let's say, on safes with 7 million post valuation, and you are like 600K raised, and you only have 100K left for us. Okay, sounds good, but I'm not sure that you have justified your 7 million valuation yet, and you're telling me that it's somebody else might take it next week. Okay. But if I don't think you justify the valuation, then I'd rather wait several weeks. And in vast majority of cases, nobody else takes it. We actually had really bad case, really funny, let's say, case this year. I cannot name the company, where the founder told us that they got around like safe round as well, almost done. They only have 100K left, and they want to close around like 2 days from now, which is, we almost never turn around to 2 days, right? So after founders reach to us, even if we like the company really well, we want to do our due diligence analysis, and it's 2 weeks, right? So, and in this case, they're like, oh, it has to be this week, like by Friday. They're like, okay, we actually scrambled. We created a memo. We really did everything to analyze this company. And then we decided that, it doesn't look that good. So we decided to, and also we felt like we don't have enough time to do some customer checks, so we pass. And then what happens? 10 days from then, he writes us again, hey guys, I still have room in the round, maybe you want in. I'm like, didn't you tell us 10 days ago that that it's Friday or bust? And like, yeah, so this really backfires, right? So this artificial FOMO really backfires. So I think the more real FOMO is when it's a priced round and the terms of the round say that it has to be closed by this date, and when the founder is completely okay if it's not fully filled. And yeah, that's more realistic. But yeah, what I see is that we much rather pass on the artificial FOMO than just like jump without thinking into the deal. And what we see is that 90% of the cases we can still invest, right? So, and it's very important to be thoughtful, right? So, because one of the things is that we invest not just money, we invest time, time of our team, and if we do a wrong decision, then we are married to that company for a long time, and we will have to try to help them. And if it's a wrong decision, it will be really difficult to help them. Right? We'd rather spend more time, but then make this really informed decision, and then put all the resources to help the company.
When you commit a check to the company, is it in a single tranche as well, or multiple tranches?
No, it's always single tranche, right? So in VC, it's like multiple tranches, more unconventional, and I don't recommend founders take those deals. So. And when it's on safe, it's very, very, from date we commit to us wiring is very, very quick. So it's typically like, several days at most, right? So there's some legal work, and that's it, right? So we actually, I personally don't like all sort of like soft commits and like conditional commits and so on. It's like when we commit, right? So, and some funds end up having this whole folder of the startups that they committed if something happens or if they raise a round, and then they never do, right? But then how do you plan your cash flow and everything? For us, if you commit to a startup, we wire the money, and that's it.
Touch once, yeah. So you picked the company to invest. How do you win the right to invest? Because good companies, they have a lot of competition among investors.
Great question. So first of all, I think that with the current situation on fundraising for VCs, this is a much less of a problem than 2021, when there were a lot of this so-called tourist VCs, meaning that people who had no VC experience started to open their VC firms, like celebrities, sports people, actors, or just successful founders who never invested. And then those VCs started throwing money around, and then everybody's like, "Oh, I want to have so and so star on my cap table, so I'll give them the right to invest instead of a professional VC who is like less famous." So this year, it's like all those people are gone. There's very few exceptions. I think like Serena Williams is the one that's still running her venture fund, but yeah, but there are very few. And what I see now is that smart founders make room for all value-add investors. And one of the approaches that smart founders do is they also try to reduce checks of larger investors, right? So for example, if the founder wants to raise 2 million at 10 million valuation, and then they manage to convince an investor who wants to put 1.5, smart founder would convince that investor to only put 1 million or 750 or 500K, and then use that big name and that lead to actually get 4, 5, 6 other investors. Because in the end, 2 million is 2 million, it's the same money, but you'd rather have 6 VCs help you rather than 2. So, and we find that our check size between 100 to 100K is perfect to get into any deal. We actually have one case when we got into a 3 million round where there were already 2 leads, 1.5 million each. And the round was pretty much closed. It was 3 million on 12, and it was like 2 leads. And we convinced the founder to increase the round by 150 to get more dilution because of our value add. But now question how, right? How do we convince, so on? And that's where a lot of things that are, well, first of all, I want to acknowledge that every single VC, almost with very few exceptions, speaks about value add, right? So everybody tries to say like, we are helping this and that way, right? And we are not completely unique in having value add. Every other VC has value add. What I found is that our value add speaks to founders, right? So one is that we are very well set up for follow-ons. Not all VCs are. So when we put in 100K, we say that, but this 100K is a path to get a couple million more from us. Second is we are fundraising experts, right? So, and I keep talking about fundraising publicly and privately, where founders understand that they can ask me for advice, right? And every month or so, I get like more and more and more experience. Just this year, I shepherded probably 4 of our portfolio founders through really complex seed rounds, right? Which we didn't lead, but we helped the founder to not only find the lead, but to negotiate with the lead, to work out all the details, to understand what they, it's basically being on the same side with the founder, to like look out for their interests and how exactly to form this round, who to let in, who not to let in, how to work out all these difficulties. And the founders are thankful for that, right? And so it's very easy for me to get references from our portfolio founders on like how we help them. Introductions are really big thing, right? So we do a lot of introductions. I even created a whole system to make our introductions take less time from me, right? So like automate them. But in the end, I can introduce a founder to like 50 or 100 VCs directly, one-on-one, super warm introductions with a lot of endorsement. And our best founders ended up raising 3-4 million just through my introductions. And that 3-4 I mean on seed, right? So, and basically a lot of this fundraising help. Then we have my partner Vadim, who is in a very unique position that he is very active in our VC, but he also is full-time CEO of Series A startup. So he coaches all of our pre-seed and seed founders on how to build their company, how to hire, how to sell, and how to raise the next round as well. So, all of that, plus our unique events, our unique community and so on. So what I see is that in the last couple of years that Geek Ventures exists, people heard that we are helping startups.
Mm-hmm. How did you decide on having a co-founder for your fund? You could have done it on your own. And what's your advice for aspiring fund managers? If we were to pick a co-founder, what's the right way of doing that?
So I decided to basically be a solo GP from the perspective that there was nobody in my close circle who had the right investing experience, who was at the same moment in their life to raise a fund right then. And also, I felt that I could do it on my own, right? So I think that it's really more like very personal, maybe emotional decision to do it on your own, or 2 people, 3 people, right? I most recently spoke to another VC managing partner who is one of 3. So they have 3 general partners, and they basically have this like kind of separation by sectors and separation by like LP basis and so on. And what he said that the difficult thing was to align everybody's start date, right? So because everybody was in different life stages, and then it basically delayed their start of their fund by a bit, right? So I see that most funds that I see, first funds, are actually solo GP funds now. It probably was less typical 10 years ago. Now it's very common. So maybe some of the funds end up having 2 partners or 3 partners by the second, third fund, right? And I don't know what will be in the future in my case. But yeah, so in my case, I decided to go for it alone, and one thing that is also is a reason to partner with somebody is how your fundraising going, right? So for example, I think that the perfect size for the first fund is between 5 and 20 million. My 23 is a little bit outlier on that. But if you can only raise 5 million on your own, then partner with somebody who can raise another 5 million and together have a 10 million fund makes perfect sense. If you can raise 20 million on your own, then partner with somebody else and raising a 40 million fund might be a bit an overkill on the first fund. Because my thinking is that when you have too much size on your first fund, you might end up doing expensive mistakes, right? So because the higher the fund in size, the more difficult it is to return it, right? So
when it comes to building your investment team, what's your approach there? What help do you need once you raise the fund? What kind of employees are you hiring?
Great question. So happy to go deeper into that, right? So I have part-time partner Vadim, who is splitting between our fund and his startup, and he is doing investment work and also portfolio management work. And then I hired first analyst and then the second analyst. Both analysts are now associates, and then I hired operations manager and then a principal, right? So it's like 1, 2, 3, 4, 5, 6 people total, right? So and an assistant, so it's like 7 people total. So my thinking is that whenever you raise at least 5 million, you should hire somebody, at least an analyst. What I think that I've seen some like really one-person operations when the whole firm is one person, there's nobody else at all, and I think it's very inefficient. It ends up being like less diligent. It ends up to be extremely like intuition driven. It ends up being FOMO driven and so on. So and also I think that whenever you have one person who is very focused on fundraising, you have very, very little time on investing. So it's very, very important to have at least 1 or 2 people, whatever it is, like analyst, associate, principal, who are 100% on investing side, who are not looking at all into fundraising and other aspects, because this is how you get deep into understanding. This is how you will have time in your team to do additional calls, to to analyze the market, to talk with customers, to understand the competitors, right? This is how we are able to process 100 deals a month, right? So because if it was just me, it would be really, really difficult to do that. So I think that was actually my mistake, that I postponed for 6 months hiring the first full-time analyst. But now I'm very, very happy. So we have 2 associates and the principal full-time, and that is like really good core team, and even for fund 2, right? right? So it's,
they can take care of phone screens,
Yeah.
and then I assume they write a memo, which
correct.
will come to you.
They write memos, they present companies, they start splitting the areas, right? So when it was initially analyst, he was covering everything, but now we are split by industries, by sectors. So then our teammates see the very similar companies and they talk to them and they can compare them directly, right? And they can go very deep into analyzing the market and so on. So spend more time on that.
And that gives more leverage to you as a solo GP. Let's come to the helping companies. So you invest in the companies, you want the right to invest. How do you help them? You already talked a lot about that, but maybe some unique ways you helped out. Maybe tell us maybe some war stories of how founders called you at middle of the night and anything like that.
Yeah, so I think the most interesting war stories are all about fundraising. And unfortunately, most of them are like so clouded in privacy that it's really difficult to tell. But at least like there was one story when everybody wired, I mean, all VCs participating in the round, signed the papers, wired the money, and the lead investor didn't wire the money. And the morning the founder calls me and says the round is off because the lead investor called them and said that the docs are wrong because the employee of that fund that was leading the deal did something wrong. So the partners of the fund are canceling this whole thing. And then I basically had to work with that founder, not only me, but other VCs who were like still in the deal with that founder over weekend, over next week to try to figure out how to continue with that deal. But yeah, these things happen a lot, and especially because my specialization personally is on fundraising, that's where the founders call me, right? So when something happens with the round, right? So, and this is like one of the biggest things. Another cases where I actually helped another company with interviewing for a CTO position. So with my engineering background, some like non-technical CEOs asked me to help with that. So a lot of war stories related to introductions and sometimes salvaging introductions, like in the sense that the founder tells me that they spoke to somebody that I introduced and they screwed it up somehow, the call. So I need to talk to that investor and try to there are things like that.
Yeah, we'll look forward to your memoir when you retire to hear more. Let's talk about the liquidity events, getting to exit. In 2021, I believe Sequoia decided to become an evergreen fund where they would keep their positions at IPO. Union Square Ventures is known for just selling all the stake and returning to their LPs on events and sort of on the liquidity events. So what's your approach there? What's your thinking?
So I think that everybody should be focused. It's very, very core to be focused and thinking about what you can do best, right? So I hope that when Sequoia decided not to sell the IPO, they actually hired people who understand stocks very well professionally, right?
Former hedge fund managers or
something like that, right?
Yeah.
In our firm, we don't have public stock specialists and we don't plan to. So our plan clearly to sell at IPO, because how the stock moves after IPO, it's out of our specialty, right? So, and we are also not late stage specialists. So our approach is actually to gradually reduce our stake as the company goes up. So basically, so it's not a very specific, financially written policy, but our plan is to, after a company reaches at least 10x and we are able to sell part of it, we want to liquidate 10-20%. So basically, when you liquidate 10% of your stake at 10x, you return the principal. Great, right? So, and then after that, you can keep liquidating 10% at every round. Right, so and basically keep returning to investors. But our approach is also to not liquidate everything too early, because sometimes companies go 1,000x or 10,000x, and you want to make sure that if we have a company like that, then we have foot in the door to get those money.
10% in every round is actually a very smart strategy, because you keep the potential, you keep upside, but you also lowering the downside.
Yeah. So for example, those funds that existed that started in 2018, 2017 and didn't trim their position in 2021, they feel now really, really bad, right? In 2021, nobody knew for sure that it's top of the market, but people needed to trim their positions, right? So I trimmed some of my angel positions in 2021, even though it looked like it's just in the middle of a bull market and it will go. But that's the thing of diversification. You need to diversify personally, and as a fund, you need to help your LPs to diversify. So
wonderful advice. Tell me about the difference between mediocre and excellent investors.
Great question. I think that one of the biggest difference is ability to get conviction in face of a lot of information, right? So what I see that a lot of beginner investors, when they see great companies, they end up going either one of the directions. Either they invest in nothing or they want to invest in everything. And by even not in everything, but like too many, right? So, and this is where I coach like my team and the beginner, like not managing partner, but more like VC team, associates and so on, is that learn how to put most of your conviction behind fewer companies, because it's actually a kind of a cop-out. It's fairly easy to say, oh, these 10 companies look great and they all could be unicorns. Yeah, of course they all could be unicorns, but tell me how and why you can create this conviction that each one of them is better. Rank them, right? So being able to build this conviction is really a good sign of a great investor, and explain this conviction. Being consistent in like taking, so even though, especially at early stage, you cannot just look at very few clear numbers, like here's sales, here's growth and so on, or like here's burn, but you still need to be consistent in how you look at every company. So to not forget that one thing that was a red flag in one company, another company is not a red flag for you. That would be bad, right? So be very, very consistent in applying your methods. Also learn. Right, so learning is maybe something that was a red flag last year is not a red flag now. Like for example, I think like down rounds, right? Is a good example. 2021, anybody down round was a red flag. Now it's not, right? So also in the learning fashion, just being able to move ahead of the market. One thing that makes a really, really good a great investor is being able to see the trends where they're just bubbling up, not when they're, but also understanding when they're too high, right? So for example, a lot of investors invested in generative AI companies in like March this year, when they all had the chart of their usage really going up. And a lot of them, and I've seen those charts, start in May, started to go down in usage, right? So where the growth was plus 40% month on month, suddenly started going minus 15% month on month, because their users like were tired, right? So try to make sure you're not investing at the high, the top of the hype, right? But instead, be very, very deliberate in trying to analyze what is the future, where is the next interesting thing, or like next interesting trend that could be there, but which is real, which is like multi-year. Another thing is like, yeah, being able to think multi-year, right? Think multi-year, think like 5-10 years, and also not being too anxious about missing a deal or or failing it, or going into a wrong deal, right? So one thing that is important is that build conviction, but at the same time don't agonize about it, right? So because I've seen some investors that spend too much their mental power on like, oh, did I just miss a company? Maybe I should have invested in it. Keep in touch with the companies, and if you think you have missed it, invest at it. Convince them to take money at higher valuation if you think it's a great company. But don't be just anxious about missing it. On the other hand, if you're already invested in something, take it mentally at least, or like easy, right? So it's like yes, it might be wrong investment, but it's par for the course. That's part of investment game, that sometimes you invest and the company fails. But take your lessons from it and understand the big difference between this company failed and I should have seen it, or this company failed but it was the right investment. So when I'm trying to analyze post-mortem companies that failed in my portfolio, I look at like, was it the right investment at the time or not? And there are companies that were the right investment at the time, but still failed because, and maybe even the founders did everything right, but then something happened. Maybe one of their macro situation happened, or maybe one of their partner companies relationship went sour. Maybe the founders stopped working well with each other, right? So, but try to learn about all the risks that could lead companies to failure and analyze them in the future. Yeah.
Wonderful advice. So sort of separating the quality of outcome from the quality of a decision.
Yes.
Because of two different things. Speaking of misses, what's your anti-portfolio? You had an opportunity to invest, but for some reason you passed.
I think my biggest one is Coinbase.
Yeah.
So it was same year as Instacart, and I felt that, I felt that, I was just starting, and I was like, and Bitcoin was not that convincing to me yet. So I looked at it, I looked seriously at it, and I thought about it, and then decided to pass, and that was wrong because it could have been another like 200x or 500x. I think that's the biggest one. Another one, let me think. I think the interesting recent one was maybe Spellwise. So Spellwise is a company of a founder that I backed before, Sergey, who created company Sayana. I was the first investor. He sold this company to Headspace, and then he started this generative AI keyboard company called Spellwise. And like literally half a year later, he sold it to Perplexity. So, and that was an exit like a couple of weeks ago.
And you didn't invest? Why?
We didn't invest because it felt like it was a bit of a unclear future, right? So, but well, this is just a very recent story, so it's difficult to say. But yeah, that's another very recent example, right? Coinbase is obviously much older example.
Difference between mediocre and excellent founders?
I think the one interesting thing is that excellent founders often don't think of themselves as excellent founders. It's much more common to see this complex of imposter syndrome in really excellent founders, right? Because they're always striving for better. But one huge thing that excellent founders are able to build excellent teams, and when you find absolutely outstanding people joining them as in like in non-CEO roles or even in non-co-founder roles, that's a great signal for me. But also founders that can, what is important is that founders can really, be resourceful and be able to switch very easily from operational level of like, solving problem now and like what's in the next few weeks to this like high big picture level where like, and they are able to think in like in a unicorn level, like decacorn level, right? So almost all founders that you know about that are like top of everybody's mind, like Steve Jobs or Larry Page or Mark Zuckerberg, they from the very beginning they had grand ideas, right? So but at the same time they were busy solving the problem now. And bad founders have just one of them. Either they solve a problem that's just too small, or they have grand ideas but can't execute, right? So,
you talk to a lot of immigrant founders targeting the U.S. market. Tell us about the mistakes immigrant founders make when they build businesses in the U.S.
Great question. So, first of all, some founders don't migrate to US and try to build business in the US from abroad. And I think that even though like after COVID, a lot of investments are done by Zoom and it's still very, very difficult. What we see is that when you want to, those founders that are trying to build in the US but live abroad for like whatever reasons, like family reasons or price reasons or other reasons, they find it much more difficult to raise money and also to sell their product to US customers. But another mistake that founders from abroad don't try to, blend in or somehow assimilate a little bit with US ecosystem, because US is the most immigrant friendly ecosystem, but it still requires immigrants to kind of play by the rules, right? And some founders are just too different, right? So, and they don't want to change, right? So one thing is that I say everybody's like, yeah, we want to help immigrant founders become more, same kind of speak the same language with US investors. So another mistake that a lot of immigrant founders do is like going for one of two extremes with the valuations for their startups. Either they go too low because they're extremely humble and they're like afraid, and then nobody takes them seriously, or they go too high and then they don't understand why similar startup with Stanford alumni founders can raise a 20 million valuation and they cannot. And they don't understand that that a lot of this is like, they're not in the bubble. They're like a little bit outside the bubble, and therefore they cannot do the same thing. Yeah.
Let's talk about your career. You spent 12 years running engineering teams at Google and Facebook. Lessons learned from Google and Facebook.
Oh, great question. So a lot of lessons learned, right? So I think the most interesting lesson is that engineering, especially engineering management, is a people job, right? So, and it's all, and when you try to build a product, it's all about people first of all, right? So, and this is what like basically translated into my my investment is like that. It's almost never now, especially about quality of technology per se, or like how good your code is. It's all about quality of people and how you can manage them, right? So because even the great people can be really turned off and non-productive, and the CEO is a micromanager. So this some things. Like one other thing is that whenever the bigger the company, the slower it is. So one thing that after working at Google and Facebook I know is that the chance that Google or Facebook will clone your startup's idea are close to zero, right? So it's almost never a risk we take seriously as investors, that some big company will just write the same thing. We think that a big company might buy a startup instead. And another thing is that management matters. It's a kind of continuation of the first thing, that it's almost impossible to build like engineering team or just a team without hiring specialized managers after some number of employees, like 8 or 10, right? So, and the startup founders that never worked in like big environments can sometimes be optimistic and like, oh, I'll just hire go-getters, A players, and just hire 20 of them or 30 of them, and we don't need any managers. They will figure out what to do. And in reality, it doesn't work. So like any team more than like 10 people needs a proper organizational structure.
I think it was a period when Larry Page thought that at Google.
Yeah.
Top 3, your favorite books?
My favorite books is Game of Thrones by George Martin. Then Hard Thing About Hard Things. And number 3 would be emotional
intelligence.
Emotional intelligence. That one, yes.
Favorite movies or documentaries?
Favorite movie is Back to the Future, The Matrix, and number 3, either Dune or Oppenheimer from the recent ones.
Wonderful.
Difficult.
Favorite podcasts or YouTube channels?
Great. So I listen to Stratechery, 20VC. These are the 2 main ones. Number 3, I, keep alternating between Today Explained by Vox.
Wonderful. Your favorite blogs or Twitter accounts you love following?
Great. So I follow a lot on Twitter and LinkedIn, but it's really difficult to say specific names.
Is it typically like FinTwit or AI? What are your favorite topics?
All VC. So almost the main topic that I follow is VC and a little bit of AI, in general.
Three of your favorite quotes, life principles, something you would put on your wall in your office.
So main one is talent is distributed evenly and opportunity is not. Yeah. So it's not the result that matters. It's more like the effort and your approach. I don't have another one.
3 of your favorite restaurants in New York City or Bay Area.
I'm not a big food person, so I really don't have favorite restaurants.
3 cities to live, not to visit as a tourist, but to live.
New York, San Francisco, and third one is difficult because these are the only ones that I would seriously consider to live in as a VC, and the only ones that I would recommend to a startup founder. But the third one that I think I could live if I was a little less VC oriented would probably be Barcelona.
What did you learn about yourself as an investor in the past 11 years?
What have I learned about myself as an investor?
How did you change? What's your evolution?
Became more cynical, I think, in sense that it's very, I always started very passionate, and it's really, really difficult to be passionate when you look at 200 startups a month. But still try to, maintain that passion because it's extremely important, the startups that we invest in. I find that the really interesting ideas and startups can get me out of bed, can really take me from anything else, and just basically I feel that I can find sometimes 100-200 hours a week just because there are great startups there.
My final question to you is, what is your dream?
My dream is that there are no borders in the world.
Why is that?
We invest in immigrant founders, and one of the reasons we invest in them is that there are many, but one of them is that immigrant founders who came to the US came through the most difficult, or one of the most difficult immigration systems in the world, and if they're able to do that, they are well set up to build a good company. But in general, I find that too many lives, it's again like too many talents are wasted because people cannot live where they want to live, and too many lives are really not being well because people are spending too much time in trying to apply for visas, too much they're tied to their wherever they are and they cannot travel. People are very limited in their thinking because they cannot travel, and so on. So I wish everybody could travel everywhere, right? So and decide to live anywhere.
Thank you, Ihar. Continued success. Thank you for finding time.
Thank you, Arman. I enjoyed it.
Ihar Mahaniok, Geek Ventures. Be so good, they cannot ignore you.